This is Peter Bell. I made this recording for the transcript.
So all that macro market structure stuff that I said about monopoly, monopsony is kind of whatever, but it's not completely irrelevant to the situation. So if you look at Geomega or you look at Medallion, it's pretty unique production scenarios, right? It's non-mine production, right? Medallion is recycling waste from sands, heavy sands processing for titanium stuff, and Geomega is doing magnet waste recycling, really, which is pretty exceptional. Closes the loop on the product life cycle for rare earths. Only person in the West talking about doing that I know of. Maybe others privately, only Pubco doing it. It's done to some degree in China, but that's opaque and uncertain. So the whole point of like China as a bottleneck or whatever is just simply that they have market power, and so be careful. Don't try and go up against them, or you'll end up like Linus, having to warehouse your production at the same time as the Malaysian government's giving you a hard time about permitting and recycling and costs of production or operation for your plant. Nasty confluence of events. Point being, Linus' production size is substantial, right? So if you look at Geomega in comparison, it's much smaller. Geomega is talking about like 200,000 kilograms of rare earths, right? 150,000 kilograms or something like that. NdPr prices, ballpark, $50 a kilogram. Kind of rule of thumb that I like to use. And the Geomega basket is pretty good. They've given some guidance on it. It's interesting stuff. It's NdPr, but it's also dysprosium and terbium or something like that. So, which are more valuable by a multiple of order of magnitude, even in some cases. Dysprosium prices versus NdPr right now, I think still. Anyways, there's a rabbit hole there around product pricing, but I would say simplest thing Geomega could do is focus on the NdPr and focus on offering a contract. So put out a contract for difference where there's no strings attached on production risk or ability to deliver, just a specified quantity over a specified window of time, and say, look, if we're going to try and produce this, and if we do, we'll sell it, and we'll give you the difference between what we get for it and some spot price that we set. And you pay some premium for that up front, and then you hold that upside, that optionality, over our first batch of production. So, potentially interesting bet. I think if you structure it a deep in the money call, it makes the person who's buying the option basically long from the start, which is a good place to be. And if you do it just for the NdPr, it's a relatively thick enough market that you can sell whatever you want in the spot. You don't have to worry about trying to, if somebody else wants to warehouse it, the final metal, that's fine, they can do that. But Geomega, if they just sell their first batch of production on, and then they auction off their profit margin on that production, basically, is another way of thinking about what I'm talking about. If they do that, they could collect some nice premium for that up front. You'd have to find somebody who can take the risk. Some of the uninsurable risks there around production. You really want to make sure that there's no liability implied in this kind of a contract for Geomega. I really, you wouldn't want to see it impair the financeability or the investability to other parties. You don't really, you want to keep the capital structure there clean. That may make the contract untenable, if you're talking a first batch of production that's never been done before. Some question marks on that, right? So If you keep the scale down though, and you're only talking 200 tons of, or, you know, say you're even just talking 100 tons of NdPr, that contract is in. And it's interesting in context of the macro market structure, because if you're facing a market where somebody has their weight and they can throw their weight around and push you around, and you're talking about being a new producer in that space, then you got to be super careful. And if it's a monopsony, if the rare earth metals are a monopsony and there's one seller, and you're talking about being a new producer, then you better have your buyer, you know, in mind before you produce. I wouldn't recommend doing that with forward sales or offtake agreements, because this stuff you're producing is like super niche, right? And if you're the first producer of it in the Western world, quote unquote, then there's some optionality or something. Again, you could talk about the security of supply, the value of having access to supply to some buyers. I don't know what that's worth to anybody, but I would like to make that point again, that looking at the macro market structure of China being a monopsony seller of rare earth metals, are they not? You know, to some degree, it's probably fair to say so. Go along with me on that and talk about being a new producer, you know, specifically a small new producer, right? If you're coming into that market and you're going to try and produce a large amount to rival, you know, like, you have to make sure your demand's there. And that's a big question that, you know, that's when you get into offtakes. Is if you're talking about 10%, 20% of world production today, you better have buyers really lined up, you know, or else you're in the Linus situation where you're warehousing your production, which is a really slippery slope, especially if your production starts to falter. So Linus is a pretty big player really globally, and they need to be careful. Geomega is small potatoes at this point. I don't know what scale Medallion would come in at, but they're adjustable. Medallion could start small as well, and if they did start small, then they could just sell their production, you know, kind of on some sort of a spot market or something. You know, I don't know what kind of spot delivery, spot demand, you know, there is for whatever Geomega might produce, or what kind of prices they'd be able to get. But supposing that there is some demand out there for this product, it's a question of like, who would pay to get exposure to that price, right? And if Geomega can offer a solution where they're producing the stuff, sourcing the feed, you know, processing it, producing the material, selling the material, then, you know, it can be purely a financial transaction between whoever's going to buy that price upside, right? And that's what, so if it's just an NdPr basket that you're selling, you know, maybe the reference price is $50, maybe it's $40. You know, something that's deep in the money makes sense to me, because it puts the buyer in the money. It makes them long already, right? I've said it before, I'll repeat it, but yeah, so coming back again, market structure, macro, if you look at if you say again, monopsony, one seller of rare earth metals, that may be the case on the macro, but I don't think it's the case on the micro, because I think the demand side for that product is growing really quickly. So it may be that looking backwards, a lot, you know, one seller and most of the demand's just nearby domestic, but going forward, I think there's metals buyers, rare earth metal buyers around the world growing at a very fast rate. I said it's a very large growth market, ex-China. And it may be a small market right now, but Geomega is talking about production at a small scale. So China may have the macro locked down, but if you come out with small production, you target the small demand segment that's growing, then you have a chance of playing in a different pond where Geomega isn't in, or where China isn't in quite so much control. right? You know, there's still a connection in price. Like if your basket is NdPr and most of the market is there, fine. That's, you know, you can use pricing set there. But depending on your counterparties, you can come up with different types of pricing too. Like if you get some USDLA, like military contractor guys who want to price based on, you know what, like cost differentials. Like if using this stuff improves the costs of some production process for the military by, you know, decreases cost by 10% on a $100 million line item. You know, like maybe there's a pricing calculation ex-China that uses that calculus in some way. So that's all stuff that on a market macro scale you want to consider too, right? It's like pricing, prices, where are they set, how are they set, where's material traded, who's buying, selling, and with GeoMega doing something small, they can kind of avoid some of the problems that bigger producers would have. And they can target some of the small new buyers. So it's a case of buyers wanted, right? And then it's just, well, a buyer of what? You know? And really, I guess the answer is, you know, rare earths, really. You know, like you can have a financial buyer who's just there to speculate, but to have somebody who's more concerned with the whole economics of the thing is worth considering. So, say 3 buyers come to mind. 1, more money than sense, just looking for a gamble. 2, house position. So I posted about, you know, if GeoMega is selling these contract for differences, then they're playing the house to some degree. That house position is assignable to some degree, and there may be entities who could, you know, hypothecate, rehypothecate, securitize, and expand the scale and scope of financial derivatives based on all these rare earths. That's very interesting. I don't know who would be able to do that, but I would point out that in the case of the mortgage-backed securities, there was eventually a large pyramid kind of inverted on a fairly small universe of underlying financial products that were just abused systemically by a proliferation of contracts based on them, you know, and all the reflexive feedback loops and things that went along with it. You know, you want to discourage that largely, but there may be some niche for exposure to the economics of rare earths, right? Like if you were to offer CFDs, you know, on the scale of some ISDA type thing or whatever, right? Like that's going to be way too big for the physical market at this point. But you know, even $10 million is something that is an interesting number to mention, you know, in relation to contract size universe, right? It's small, but not zero, and positioned to grow significantly, right? So, you know, maybe that's a case of selling that offshore in some way outside of any Canadian or US, European banking regulations. Just, you know, that gets to be a question mark for GeoMega, but, you know, if GeoMega is selling it to somebody and that person is selling it offshore, you know, and then there's some gambling that's happening based on that exposure, you know, amongst a group of brokerages or whatever, financial institutions, even offshore, like, sorry, that's just business. I don't know if there's any problem, you know, potential for problems with that, but it doesn't have to be a disaster. Anyways, sorry. So, and the third buyer again would be a physical buyer. So think USDLA, you know, somebody who's a physical buyer again. There may be physical buyers who would say, it will take some of it for testing, but we don't want to commit to buy your whole production or whatever. And they might buy the financial exposure, right? They may not want to commit to take the full physical delivery necessarily, but they may take the full financial exposure. And then, you know, they could be a first buyer or a backup buyer, a last buyer in some cases. Kind of depends on their preference, right? But that's something to consider. So that's about it. I wouldn't say anything else really at this point. Two kind of audio notes there, and they're both pretty comprehensive treatment of what is a fairly simple idea, which is that new rare earth producers who are taking like alternative route to production with like low capex, like Geomega and potentially like Medallion, you know, they're looking at production at small scales, and for them to consider securitizing in some way or selling a financial interest in that production. If they could engineer that kind of a transaction in a way that didn't entail any liabilities, you know, on failure to deliver or other obligations on their capital structure, if they can do that, then it's a non-dilutive way to raise capital from selling forward production. And non-dilutive financing in a low capex scenario is really, really important and needs to be investigated very closely at every opportunity. And when you're looking at a product market that's a growth area, a market segment that's new, you know, Western producers of rare earths, small, like that's new, and then the whole recycling thing that both of those companies are doing, that's new. Geomega is explicit recycler, and Medallion is waste, reprocessing, repurposing waste. In either case, is great growth and the potential for, you know, new types of deals too around that to sell some financial exposure to rare earths. That's a very risky thing to do, and it's unclear if there's, you know, any interest in that from the public. You know, you can look at it and say, look, these contracts don't exist today in the West, so that tells you something. You know, there's a reason they don't exist. It's like, well, it may be true that it's not a good idea for conventional mining production scenarios, but it may be that these recycling, waste repurposing, like Medallion, Geomega, it could be that there's the potential for them to make it work with those two because they're low capex. So it's Peter Bell here, Saturday, April 27th. Short note about rare earth stuff. You think about China as an important factor in the markets globally. You might call them a bottleneck. It's also possible that you could say that, you know, there's a monopoly for them on mixed concentrate, effectively, globally, barring companies building their own processing capabilities, like Linus, and that mixed con market is really important because that's where all the junior mining companies propose to start businesses in the rare earth space, is mining hard rock deposits for mixed con production that they either process themselves or ship to China. It's largely been a non-starter. Very few of these projects have ever been built. Economics of them questionable. And what's more, the recent filings from Linus Corp in Australia, the one kind of Western company that's managed to go into production, stay in production, hasn't been easy. They have a plant in Malaysia that cracks and creates the rare earth metals that they sell. Lots to say about that, but in passing I would point out that Linus company recently announced that they're stockpiling some of their production. They said, oh, prices were weak, so we didn't want to sell our NdPr this quarter, and we're keeping it on the balance sheet. So that's telling for many reasons. But again, come back to this monopoly. That decision that Linus is making there is in a different part of the market than what I was referring to with the monopoly on buying of mixed concentrate rare earth. It happens, but it largely happens domestically in China, amongst and between Chinese entities. The whole production, that whole supply chain is in China domestically, right? They're mining it and they're processing it themselves, and they're putting it in products that are, that they're building, and they're sending it to other Asian, to Japan, I believe, in a large amount of it, for use there in further high-tech products of all kinds. And very important global market, and one that has been in the spotlight as being a critical market, strategic values for a long time. Rhetoric from the military hawks, but not a lot of business action really on it, at least not in public markets. So if you're with me that you have a buyer who's a monopoly buyer, effectively, I don't know how fair a representation that is within China, but on a global basis, it's fairly clear to say that they're a monopoly buyer, mixed con rare earth stuff. Most of the production happens to be in the same province too. Anyways, I would also say that in those broad terms, there's a monopsony as well, where there's one seller of the rare earth metal. Not really a true statement, because there's lots, though there are some sellers. I believe there's a new producer in Africa, an Australian company. There's another Australian company mining in Australia, producing magnet material in Malaysia, as I mentioned. But with the broad strokes, consider it, anyways, a monopsony case where there's one seller for the finished rare earth metals as well. If China is really a bottleneck, then it's possible to say they're a monopoly buyer in the mixed con market, and then they're a monopsony seller in the finished product metals market. Lots more to say about all that, but I just wanted to say it once here for the record. Thanks, goodbye.